Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two trusty co-hosts, Chris Dorides and Marissa DiNatale. Hi, guys.
Hi, Mark.
Action-packed week. I'm here at Moody's HQ, 7 World Trade, and it's a Friday, and I'll have to say, it was quiet the whole way from Philly. I got on the train in Philly at 30th Street Station, got on the Amtrak Acela, took the train up to Newark, took the path over to World Trade and walked over. Remote work is really here. It was, very quiet. Felt like a Sunday morning to me.
Wow.
Really.
You didn't factor in Super Bowl?
Oh, you think that's what's going on?
People are celebrating
already.
Preparing. Yeah, those tailgates.
Well, I noticed that Marissa's already prepared. Look at that. She's got
I'm wearing an Eagles jersey. Yes. I'm ready.
And that's a fashionable Eagles jersey.
Thank you.
Yeah, I can't see the whole thing, but
it's a vintage. It's a Donovan McNabb jersey.
Oh, is that right?
Yeah.
From back in the day.
Yep.
And even though you moved out to the West Coast, you're still an Eagles fan. Yeah, good for you.
Right.
Oh, yeah.
Eagles fly.
That's our guest. He's making fun of Marissa, but we're gonna introduce him in just a minute. I was gonna ask something. Oh, Marissa, do you know the Eagles fight song, touchdown song?
Of course.
Really? Can you sing it?
Absolutely not gonna sing it.
Because I went to a couple of games this year, and I should know it by now because they scored I watched the Green Bay game and they must have had like 8 touchdowns. It felt like it. I was singing that damn song 8 times. I still can't remember it.
It's catchy.
It is catchy. EAGLS. Yeah. Of course we're all Eagles fans. Yeah. And we had a webinar this week too, which is kind of like the three of us. It's kind of like we take the podcast and we make it with slides, and that turns into a webinar. It's kind of a weird thing. Have you noticed, what's the difference between a podcast and a webinar? It's all
it felt it felt like we were on the podcast.
Yeah.
Just more
a lot less banter though.
Yes, more
less banter, more formalized,
more professional.
We had a lot of folks. I think we had 1,800 clients on that call. Yeah, on the webinar. And we had, this is bugging me. We had 300 on the nose people give feedback. You ask for feedback. One person didn't like it. I was like, what? Why didn't you like it? Should I call that person up? I'm not going to call that person out. Although,
no, you should.
Kind of like President Biden at the State of the Union. Yeah. All right, we got to introduce our guest because he's biting to get into this conversation. Yeah. All right. Okay, that's not fair. Okay, Chris Herbert from the Joint Center of Housing Studies, Harvard Joint Center for Housing Studies, is our guest today. And Chris, we're going to have a formal introduction where you're going to tell us about your life story. But before you do that, what do you want to say? You want to say something?
I just wanted to say, I hope it wasn't your mom who was the one, guest who didn't like the show.
Oh, what's that? I missed that. What'd you say?
I said, I hope it wasn't your mom who was the one person who was critical of your show.
Oh, not my mom. No, my mom is a fan. So yeah, through thick and thin, she's a fan.
I thought you were going to say my mom would never listen to a webinar that
Well, that too. That too. I felt that might have been a little too, like a son wouldn't say that about her mom, but kind of thing. But
I'll say it. Yeah.
Yeah, you can say it. But you think I want to call this person up and say, what's the deal? What could we have done to, usually when that happens, they just disagree with the message. They're shooting the messenger,
That's possible.
That's a possibility. Yeah. But the other big event this week, is action-packed week, was I was in DC and I saw you, Chris Herbert, and we got 2 Chris's here. So I'm going to, say Chris for Chris Herbert, and I'm going to say Chris D for Chris Dorides, just to make this easier. And the Joint Center had was it its first in-person meeting since the pandemic, or
first one in
DC?
Washington?
Yeah.
It was our 3rd in person, but the first in Washington.
Got it. And you told me that I was your second favorite economist. That's the message I took away. Second favorite.
Well, your co-favorite.
Co-favorites.
No.
Okay.
We
Yeah.
have two favorites. It's like our children. You can't love one child more than the other.
I got it. I got it. But I still can try though, can I? Can I
You
try?
can. I wasn't that one person, by the way.
No, no, I know you were definitely not that one person. Well, the meeting was fascinating. Well, maybe this is a great place to pause and for you to give us a sense of the center, a little bit of the history, because I don't know the history and I'm really curious. And your role there and how you got that role. So maybe just give us a sense of things.
Sure. So for the Joint Center, the Joint Center has been around since 1959. So we're pretty old by academic research center standards. We were established with a major gift from the Ford Foundation to Harvard and MIT to create a center focused on urban issues. And so this was coming at a time when there was real concern about what was happening in cities across the globe. So the Ford Foundation said, we want to get these two universities thinking about it. So they created the Joint Center for Urban Studies of Harvard and MIT. So two things, it was joint Harvard and MIT, and it was also broadly urban studies. Fast forward 1971, like there was a long, pretty renowned history of the center during that period of time. People like Daniel Patrick Moynihan was the director of the center, and his work on the Black family came out of the center. Nathan Glazer, the Melting Pot. So a lot of like very seminal urban work came out of the Joint Center back in the day. But then in 1971, the Ford money ran out. Ford said to the universities, hey, we did our job, we got it launched, you keep it going from here. The university said, that's not the way we operate, up to the senators to figure out a way to do this. So Derek Bach, president at the time, said John Dunlop, who was an economist, labor secretary under Gerald Ford, sent him over to say, shut those guys down. Don Dunlop really appreciated the fact that having a center at Harvard, and we were very outward focused, we were very intended to be multidisciplinary and also to link academia, policy, and business. And so John said, I think we should keep it going. And I think what we should do is get a funding model that gets the private sector to provide funding to provide basic research into these urban issues. And that point, he focused it on housing and got a group of companies, which was called our Policy Advisory Board. So that was established in 1971. It's been around for 52 years now. And that created the stable source of funding for us to go forward. We got divorced from Harvard, and there was a divorce in the 80s, and Harvard got custody. So we've been the Joint Center at Harvard since then.
Oh, I see.
And we kept our multidisciplinary nature going with the joint part by being joint between the Kennedy School of Government and the Graduate School of Design, where urban planning is. So we've been focused on housing at Harvard. Used to be much more aligned with the Kennedy School. Now we're more aligned with the Graduate School of Design. I report to the Dean of the Design School.
Oh, I got it. And Chris, are you the executive director or what's your
my title is Managing Director.
Managing Director.
So
how long have you been Managing Director?
Since 2015.
Okay.
And I was Research Director for 5 years before that.
And I can't remember, was it Eric Belsky who was
for
you?
So
Yeah,
Eric Belsky.
Yeah.
I succeeded Eric, and Eric before him was Nick Racinas.
Oh, Nick. Yeah, I forgot about that.
He was the director for about 12 years and was really seminal. And he built up the Policy Advisory Board and did a lot to make us a much more prominent player in a lot of spaces. So
right. And you were a researcher at the center before you became managing director. I see. Okay. Yeah. Great. So you've been a kind of a housing guy for a long time, then, kind of a call him a houser. Yeah,
I've been a houser for a long time. I got a master's in the 80s, and then I went out and worked in affordable housing for a little while, decided I wanted to be a researcher, came back to the Kennedy School, got my PhD in public policy in the 90s, worked at Apt Associates doing research and evaluation on housing for about 12 years, and then I came back to the Joint Center.
Great. And so one thing I find so cool about the Joint Center in these meetings is you've got a large number of folks from across the house. It feels a lot is from the home building, housing supply, building materials. You've got a few mortgage folks sprinkled in there, a few mortgage originators, but it feels more kind of housing supply related. Is that fair to say?
Yeah, and we actually try to curate the group who are part of the Policy Advisory Board. So right now it has 64 members, and they're basically all household names in the housing sector. And we try to make sure we have a good group of home builders. And the reason is that they are driving so much of the housing market in terms of the industry side. And then we have all the manufacturers you can think of, Pella, Armstrong, Kohler, all the kind of, you walk down an aisle in Home Depot or Lowe's, those
Yeah.
companies are all there. Then we have housing finance. We have folks on the information transaction side, so Zillow and CoreLogic and Move.com. And then we're trying to get into some more of the spaces that are emerging. So we've got Invitation Homes, so the single family rental space. So we really try to make sure that when we have that group come together, and Mark, after you spoke to them, we pass the mic around and say, what's happening in your world? It's like a Fed beige book for housing. So you've got the home builders, single and multi, you got the manufacturers, you got the distributors, you got the retail distributors, you got the realtors, you got the financiers. And so you're seeing from all those different parts of the ecosystem what's happening. And that's where the group gets a lot of value, is sharing insights among each other.
Yeah, it makes sense. Well, obviously housing is kind of front and center here and from a macroeconomic perspective, because it's in recession, I think it's fair to say. I mean, home sales got nailed since mortgage rates rose. They've risen quite considerably from where they were at the end of 2021 going into 2022 when they were at record lows. And we've seen home sales come back down to kind of levels we saw in the teeth of the pandemic, or not quite to the lows of the Great Recession, financial crisis, but pretty close. Home building is weakening, and now house prices are rolling over. So I suspect, and I got a sense of this, but maybe you can give us a better sense of it. The mood in the room was, how would you characterize it? Was it consistent with what I just said, or are they? Of course, these guys are always glass half full kind of guys, which is important, very important for the business. Yeah.
Otherwise, they wouldn't be in that business.
Yeah.
The mood in the room was, I'm not going to say cautiously optimistic. I would think it was kind of surprisingly optimistic and surprising on their own self. I mean, I think there's a lot of chatter. I mean, people just come back from the International Builder Show. Builder confidence is moving up. There's a lot more traffic that the builders are seeing than they expected to see in the early signs of the spring season. The manufacturers, when they're in that room, they're looking over at the home builders to see what they're saying, because they know that's what's going to hit them 6 months later. They had a big backlog. They're still working through. Multifamily has stayed up. Commercial has been doing well. So they're all still feeling pretty good and kind of saying, I think bad things are coming, but now the home builders are saying they feel like this might be the bottom. So the room was much more optimistic than I would have thought. And I say optimistic, it's not like glowing optimistic, but more like they think that on the single family side, they might be at a bottom. Multifamily, actually, I think what I heard was there's red lights flashing and a downturn coming.
Yeah. Yeah. Do you think on the single family side, I think we have to make a distinction clearly from the single family and the multifamily. Do you think it's largely related to the movements in mortgage rates? So mortgage rates, they were, just for context, the 30-year fixed was sub 3% back late 21 at the low. If you go back to late 2022, it peaked at about 7%. And now that it's come in, it's bouncing around, but it feels like it's somewhere closer to 6, maybe 6.25, something like that. And with those movements, it does feel like it is having some impact on kind of demand, general sentiment. Do you think the mood in the room is reflecting those swings in the mortgage rate?
Yeah, and I think it's an important distinction between, as you say, between single and multifamily. So the movement in rates hit the single family market pretty much immediately, and so single family starts went from pushing 1.2 to 900,000, I think now, and certainly softening. Multifamily starts stayed up, and I think the interest rates really just drove the buyers out of buying homes. That meant that they were going to stay in the multifamily market longer. Other thing I think is that the interest rates are going to affect multifamily, but with a lag. And so multifamily folks have deals in place that got their equity and debt financing lined up. They were not about to stop last year, because I knew if they stopped, they were going to have trouble getting that financing in the future. So there's a lot of momentum. It takes a long time to get that. But what I heard at that table was the financing is now not available for 2023. And so trying to get new starts to pencil out is going to be tough. And so I think the multifamily kind of defied gravity for a little while, but it can't do it forever. So I think we're going to see multifamily starts turn down. And I think people are seeing is that consumers were shocked by 7% interest rates, but then the moving from 7 down towards 6 says, 6 doesn't feel so bad anymore.
Yeah, right. Yeah, you turn up the temperature to scalding and you turn it down a little bit and you go, okay,
Right.
I can live with that. Yeah.
Right.
So, yeah. Yeah, that's the sense I got when I was there, that, on the single family side, a bit of relative optimism, maybe the worst is over kind of optimism.
Right.
But on the multifamily side, I got the opposite feeling that, the storm is about to come. And of course, they were looking at it through the prism of supply and construction. And they're saying, look, we can't get financing. The capital markets have shut down. Banks are pulled back on their underwriting. They've raised the bar here for getting credit.
Right.
And we're not going to have the financing we need to continue to produce at the pace we have been, in 2023. That was kind of the sense I got. Yeah.
Yeah. I think the market fundamentals are that, vacancy rates were at historic lows, rents were growing through the roof. Vacancy rates have started to turn up. Rent growth is clearly slowing along with house prices. So that's also going to give them some pause, but still vacancy rates are, as much as they're coming up, they're still not high by any kind of historical standards. And those two markets are linked, right? If there is recovery in the single family market and people are able to get into home buying, that's going to mean less demand for apartments. And so they're kind of moving on, which way is demand flowing will affect the relative strength of those two markets.
Hey, Chris, let me turn to you. I mean, does that surprise you? What we just said about the mood in the room? Is that consistent with?
No, I think that's
Theory,
consistent with some other data points as well. One thing I would say on multifamily is just the pipeline is still full, right? So even though new permits, new starts may be down, certainly because of the financing issues, there's still a lot of supply that's going to come online over the next couple of years here, right? So the building is going to continue. There's still quite a bit of demand out, or quite a bit of activity, I should say, to complete those projects. But that's also going to potentially have some downward pressure on prices and rents as well. So I can understand the mixed emotions around the two markets.
Yeah, and that's exactly what a large multifamily developer in the room told me. He said starts are going to weaken next year because we've been in the starts, the actual beginning construction, very strong in 2022 going into 23, but that's going to really start to tail off because I can't get credit. But the completions, are going to remain very high and even improve in 2023 because I've got all these units sitting in the pipeline going to completion. In fact, it's almost a million record number of units, million units that got bottled up because of supply chain issues and labor market issues related to the pandemic, immigration, that kind of thing. A lot of immigrants work in the construction trades, and now those constraints are easing, and I can finish these homes, and it's going to show up in completions next year. So I thought that was very interesting. Which I think we talked about this in the past, does call into question what's going to happen with construction jobs, right? They may not fall off. They haven't fallen off. Chris, have you noticed construction employment continues to rise? There's been no decline in construction employment, and that feels like that's going to continue here going forward.
Well, you got the infrastructure as well, though, right? So
that too.
That's certainly going to continue and even increase in the future. So there'll be some offsetting if you're looking at construction overall. But the resi will remain strong because of the pipeline for now, at least. But
the manufacturers were saying that commercial construction has been a bright spot for them. And I don't know, Chris, if you've got insights to that. I was a little surprised. I was thinking office space has got to be weakening. Retail space has been weak for a while, but there is broadly commercial, they're saying, was a bright spot for them. So offsetting what's happening on the residential side.
Well, I think we're seeing a lot of construction in manufacturing, believe it or not, manufacturing facilities, which goes to kind of supply chain resilience and deglobalization. A lot of manufacturers are bringing production back home, and that's really lifted manufacturing construction.
And warehousing and that kind of.
What's that, Marissa?
And warehousing and the stuff that's sort of adjacent to manufacturing.
Yeah, it's been very strong. Yeah. So Chris, what do you think was kind of at the top of concerns for the group? What's kind of most worrisome? I guess other than the general economic environment, I was there. Hopefully I cheered them up a little bit because I said no recession at the end of the day. I don't know if they bought into that or not. But other than that, what else is on their minds? What's kind of top of mind for them?
It's the same issue that's been in some sense top of mind for the last decade, and it's labor. It's
Labor.
amazing given where we are in the business cycle. The issue that keeps coming up is just a shortage of workers. And so even at a time when you might be thinking about slowdowns, they're all talking about how hard it is to get workers. And it's, obviously the construction side we've talked a lot about, but manufacturing and transportation drivers, they keep talking about that. And one of the themes too was that, the manufacturers are saying, even if we have a slowdown, we ain't not letting anybody go because it's taking us so
Amazing.
hard to
There you
get
go.
them.
Amazing. That's
So it's
amazing.
labor. So one of the speakers we had the next day was this guy, Andrew Seeley from the Migration Policy Institute. Because one of the things they keep coming back to is we don't have enough workers. We need to get more immigration because we need to get more workers of all stripes.
Yeah. That's definitely a theme that is evident across a lot of industries. I think businesses are very reluctant to lay off workers because they know on the other side of the current adjustment we're going through, the number one problem they're going to have is finding and retaining people. So it's going to be very, very difficult.
And construction is an older occupation, right? There you have people retiring out, right? So how do you replace them?
Did you see that paper written by Austin Goolsbee and another researcher on construction industry productivity growth? I mean, one way out of this box is to improve productivity, be able to produce more homes with fewer people, fewer workers. And the point of the research was that's not happening. That there's no meaningful improvement in construction productivity growth, in recent decades, really. Did you see that paper?
I haven't read the paper directly. I've seen the news
Yeah.
accounts. I read Ezra Klein's piece on it.
Yeah.
So I need to go back and read the paper, but it goes back to the 1970s. And in some sense, my take on it was probably in response to that McKinsey work a few years ago, pointing out the lack of productivity growth. And this one seemed like it was even more pessimistic, that it wasn't just slow, it was almost negative over that period of time.
Yeah, I belong to this kind of email group of folks in the construction industry broadly, and the one of the members sent out this paper and said, what do you think? And it was pretty amazing, right, Christy? I mean, there was a lot of different theories. A lot of it revolved around regulation.
Right.
They're moaning. People. That's not the right way of saying it. People were pointing to the increase in the regulatory oversight and a lot of things. Some of which are good. Like worker safety. Would be an example of some regulation, but they were pointing to that as the key reason for the lack of productivity growth. Yeah.
Did you find the paper believable? Since you read
I did, and Austin is good. He's now going to be I think he already is the president of the president of the Chicago Federal Reserve.
Right.
And he's a great academic from the University of Chicago. So yeah, I find it very credible. I mean, there's a lot of measurement issues like in everything. So I wonder if there's, in the construction trades, it might be particularly difficult to measure some of the things that are going on, I guess, but it is shocking how the data, the numbers that are produced suggest that there's been very little productivity growth, if at all, in this construction.
It doesn't, aside from the fact that people use nail guns now, there's not a whole lot about the process that's very different.
Exactly.
Right?
Yeah, exactly. I mean, there's been some
of the safety measures, right? Some of the processes, right? So one question, I guess, or one pushback I would have, maybe where we've been measuring productivity in a very naive way or an incomplete way, right? Mm-hmm. If we're producing houses with fewer deaths of construction workers, right? But it takes longer. That's, if you did a full social calculation, it may not look so bad, right? It may actually improve.
Right. Well, I think the other thing that came out of the discussion for me was just, how serious the shortage of housing still is. I mean, that it's gotten kind of pushed to the sidelines in the last year because of the housing recession, but the severe shortage, particularly of affordable housing, it continues to be an issue, continues to be a problem, and actually to some degree maybe getting worse because construction activities come down. We're producing fewer single family homes today than we were, a year ago, and so that's not helping. and you had HUD Secretary Fudge there, and she was talking about, what can we do to kind of address these supply side issues, to try to get more supply. Do you have, if you were king for the day, and maybe king for the week, or is there a policy or two that you would focus on that could move the dial here in terms of supply, trying to help with regard to more affordable housing?
Yeah, I think there, a lot of the conversation about just the complexity, the length of time, the obstacles in place, particularly to smaller, higher density housing, is a big part of the problem. And so I think we would, if I were king for a day, or maybe better put, if I were governor for a day, then I think at the state level, we need more action to take back from local governments the ability to make building restrictive. It's really a state prerogative. They delegate that authority to local governments. And obviously local governments are not thinking about anybody's best interest but their own. And in their interest, it may be good to restrict supply because it pushes up prices and keeps out folks that might demand more public services from them. And so I think states need to take steps to say, no, we have a collective need to produce housing of different types in a broad range of communities. So I'll give an example from my own state in Massachusetts. Under Republican Governor Charlie Baker passed a law that communities served by the mass transit system, or either directly or adjacent, and it's 175 of them in the broader Boston area, have to have a minimum of 50 acres of land zoned as of right for housing at a density of 50 units an acre. And that 50 acres is a minimum. If you're a bigger town, you'll have to have a larger requirement. My own suburb of Lexington, that came out to 82 acres. And I can tell you it changed the whole dynamic in my own town from, as the planning board, I was on a comprehensive plan advisory committee, coming forward to say we need to have a greater range of housing in town. And there's a lot of public sentiment in support of it. But it's difficult to push through. But then when you say, oh, there's a state mandate, we have to do it, where are we going to put it? It just changes the whole conversation. I think it'll be interesting to see what happens in Massachusetts as a result of this, because it's going to allow as of right development in every community in the Boston area, and not huge areas, but enough to say that's a lot of housing if it got built out. So I guess that would be my magic wand. Do that kind of a thing in a broader range of places.
So you're saying that you need leadership from the governor to kind of lay down the law to the rest of the local governments to say, hey, you've got to change your zoning and permitting to allow for more higher density kind of construction.
Yeah, and it's flipping it. So rather than saying it's up to you, we suggested, it's saying you have to do it. Where are you going to do it?
Yeah, isn't that a tough thing to do? I mean, I can maybe in Massachusetts, but I don't know. That feels like it's a pretty tough thing to sell.
I mean, Massachusetts is a blue state, but I will say that the typical, the mantra has been that liberalism ends at the driveway. And so even though we're a blue state, the governor was pushing for a number of years to try to change the laws relative to votes at the local level to have a zoning change, which had been 2/3 majority. And it took forever to get it to change just a simple majority, but he got it through. And then he got this through. And I think, he's a Republican. I think it does bring together Republicans and Democrats, folks interested in affordable housing from the point of view of folks, the residents needing that housing, but also business who say as a state, we're not going to grow if we don't have an opportunity to bring more people in. So Utah is another state that's having a lot of action at the state level to try to overcome local barriers. And that's a very red state, but the business community is spearheading it out there.
Okay, I think we can allow you to be governor for at least a day. Which state do you want to be governor for? Just asking. I'd pick a big one, Chris.
I love my home state.
Okay.
But Maura Healey, she's doing a good job. I don't want to kick her out.
Well, it sounds like you're announcing for governorship. That's what it sounds like. No,
not
okay.
here.
Not exclusive.
Yeah, got it. Hey, Chris D. How I've lost a little bit of track here. We estimate the shortfall in housing supply based on looking at the vacancy rate. If we look at the vacancy rate across the housing stock today, it's extraordinarily low. And you compare that to kind of typical levels. and you do a calculation of how many units need to be constructed to be able to get back to those kind of typical levels. Do you have those numbers? I'm putting you on the spot, but do you have those numbers at hand?
Yeah, I
Just
just looked at this
context?
last night. 1.5 million
1.5 million
Where we're at.
units, homes,
units, correct.
right?
So
So
that's
about a year's worth of construction.
Yeah, and that's what the home builders have at a very similar estimate.
I think they got it from us, Chris. I'm just saying.
Did it?
They're all
it
our
all goes
clients.
around.
Yeah.
Do you know
Yeah.
why Freddie Mac's is so much
And
higher?
for some of them, I'm their favorite economist, Chris. I'm just saying. Yeah. Go ahead.
Chris,
Sorry.
Chris, do you know why Freddie Mac's number is so much higher than yours?
I believe
Yeah, they're just wrong. Yeah. No offense to Sam Cater, the chief economist, but he's of course. D, you want to explain?
I was going to keep it simple, as I believe they're assuming a higher vacancy rate at equilibrium than we are, right? So that naturally you would assume that
we're looking at the vacancy rate for homes for sale and rent, and they're looking at the broader universe of homes off the market, which is a mismatch of all kinds of stuff, and it makes the number feel a lot bigger.
Right.
So I don't think that's my own view. Obviously, I think it's the homes for sale and rent that you need to focus on. And if you do that calculation, it comes up to about as Chris D said, 1.5 million units. Yeah,
it's possible
which
that
is quite
you might pull
considerable.
more of those vacant homes out, but a relatively small share, I
Yeah.
would say.
Right.
Yeah, I don't know if you all are Woody Allen fans, but there was a line, I think it was in Andy Hall, where he talks about the two kinds of people in the world is the horrible and the miserable.
Yeah.
You just want to be miserable. You don't want to be horrible.
Yeah, there you go.
So I mean, either way, it's horrible or miserable, right? It's 1.5, 1.6, or 3. It's a lot of homes.
Yeah.
It is. But
yeah. Let me turn to another kind of thorny topic in the housing space, and that is investor demand. This also has kind of been pushed to the side a bit in this housing recession. But if you go back a little over a year ago, there a lot of hand wringing about the increase in the share of sales, home sales are going to investors, and an increasing share to institutional investors, big financial institutions that are able to go to capital markets, raise a lot of money, and come into communities and buy up homes and then rent those homes out. So buy to rent. And a lot of worries that is a problem for home ownership because these institutional investors are going to be able to buy these homes long before the average American household can, because that household has to go out and get a mortgage and negotiate a price, and by the time they figure all that out, the investors bought the property. How do you think about the advent of increased investor demand? And I'm sure this is going to come back. As soon as that housing market kind of finds its footing again and we're recovering, the investors are going to come back with I think quite aggressively, because they've got a workable business model, and they're going to be in these markets buying a lot of property. Do you have a perspective on that, Chris?
Yeah, I guess the short answer is it's complicated. But
yeah.
One thing I think that's challenging in this space too is this focus on institutional investors, and there are a lot of different classes of investors, and so I think it's important to differentiate them and their relative advantages and their differences in their management strategies. Because you highlighted a concern about crowding out home buyers. There's other folks who are really concerned about their practices as managers and how well they treat their tenants and their potential predilection to evict more quickly or the like. So, and I just caution against, painting too broad a brush of institutional investors versus others. We had a doctoral student who did some work on this using some, I believe it was, I'm not going to remember, Zillow or CoreLogic. It was a cross-sectional point in time, but he linked all the different buyers and was able to use, it must have been mailing addresses or like, to try to aggregate up to see how much the portfolio was with these different classes of owners. And institutional owners, the way he characterized it, were more than 1,000 units, but there are a whole bunch of folks, entities that own between 100 and 1,000 units. And he looked at where they were buying homes in terms of the racial composition, the income level, the price level. And institutional investors the largest scale investors tended to be in the kind of moderate income suburbs. And a lot of the smaller investors were in lower income minority communities. And so you think about the kind of old investors of, slumlords or the like, right? So there's a whole bunch of class of investors in different places. So I just want to make sure we kind of distinguish what our concerns were. But to go back to your question about crowding out home buyers, which can happen from Wall Street, but it can happen from all these other investors too. I do worry about there not being a level playing field in the sense of what's the financial return to the investment. And if you think about it, with the mortgage interest deduction, homeowners should have an advantage, right? Because I can deduct my interest and my property taxes and I don't have to claim any income. But we have very few people, particularly lower income folks, who claim the mortgage interest deduction because it's so limited now, but given the standard deduction and everything else. So, but if I'm an investor, I can claim all these expenses plus depreciate the asset. So I was in conversation with one institutional single family firm, and they noted that their cost to rent the home was less than what a home buyer would pay in a monthly payment. And, and one disadvantage Wall Street might have is that they might have a pretty high, required return from equity investors that might raise their cost of capital in some ways, even if their debt is lower. But if they get all these other advantages of depreciation, et cetera, so that I think we need to think about how do we make sure that homeowners don't have a higher cost of capital, a higher cost than these investors, if we think that giving them an opportunity to own is important.
Yeah, that makes total sense. Kind of from a tax code perspective, you don't want the tax code to benefit one class of buyer over another class, and that's what's happening. Particularly in this case, we're saying we're going to give the tax benefit to an institutional investor over an American family. I mean, really, that doesn't make a whole lot of sense. So we got to that's a really thorny problem. Try to figure that one out.
It is, and we don't really have. So what's the policy solution? You're going to, make it so investors can't own single family homes? You can't do that, right? There's a whole host of reasons why actually having capital flow in is a good thing and having that supply of housing. So it's really, you need to have tenant protections to make sure people are treated fairly. And then I would think we need to think a little bit more about how do we make sure on the financial side, there's more of a level playing field between homeowners and investors.
And we say financially, you mean the tax code.
Tax code.
The tax code, yeah. Hey, Christy, you've done a lot of work in this area too. Anything else you want to bring up here? Or Marissa, I've been kind of locked you out, but just wait, I'm coming back to you, and we're doing the game shortly. And tradition is you start, so you're up. But do you guys have anything you want to bring up here with regard to investor demand?
I would agree that it is complicated, and I do think we need a mix of
that feels a little wishy-washy to me. Yeah, it's complicated.
Yeah, but it is complicated.
Okay, it is complicated.
I've been on both sides. Personally, I've been on both sides of this issue, right? I've rented from small-time mom and pop landlords. I've rented from big corporations. I have been a landlord, right? So, from that perspective, I can understand the complication. And I can't say that one is necessarily better. There's good and bad in all the different camps. And if the number one goal is to increase housing generally, right? Let's solve that problem first. I think you need those investors to be in the market, building, risking capital. So locking them out or just painting them with a broad brush, I think does a disservice as well. So it is complicated, but I think we need a good mix of all types of buyers and sellers.
Yeah. I mean, there's certainly a benefit. You got to go back to the financial crisis. In the wake of the crisis, the housing market was evaporating. House prices were down 20-25%. And the only thing that turned it around as fast as it ultimately would have turned around. But the thing that turned it around as fast as it was turned around was investor demand, right? I mean, these institutional investors were kind of born out of that period. They came in, took a lot of risk, bought up distressed foreclosed property, and helped finally put a floor under pricing and allowed the market to start to recover from a price perspective. So it's not like they don't provide some benefit, but in this case, I worry about the homeownership effects. I do want to come back to homeownership, Chris and Christy and Marissa. I think that's also something I'm worried about longer run. But just to break things up a little bit, I want to do the statistics game, and I'm sure it's going to be very housing related anyway. So I'm sure that'll be the case. But the game, we each put forward a statistic. The rest of the group tries to figure out what that is based on questioning, clues, deductive reasoning. The best stat is one that's not so easy. We get it immediately. Although that's pretty hard to do with Christy in the podcast. He's pretty fast and not too easy, not too hard that we'll never get it. And if it's apropos to the topic at hand, that's a bonus. So the tradition is now, Marissa, you're first up on the game. What's your statistic?
Okay, there's two statistics related. One is minus 1.6%, and the other is plus 9.5%.
Is it related to the senior loan officer survey?
No.
She's laughing.
That's
She's
a
laughing
favorite.
because we were going back and forth on that one all week long.
Is it housing related?
It is.
It is.
Oh, minus 1.6 and positive 9.4?
9.5.
9.5.
MBA related?
No.
Is it house price related?
Yes.
Is it from the realtor's median existing house prices?
It is. Yep.
Oh,
So these are Q4.
I know. I think I know what it is. It's the highest and the lowest house price change over the past year across metro areas.
No, it's
No.
not.
Okay.
It's not. It's
Good
two.
Darn.
It's two metro areas that I picked. that-
Oh, geez, Louise, there's
that are-
400 plus metro areas. Okay, wait,
They're-
okay, all right, fair enough.
They're not randomly selected.
Okay, this is year over
Philadelphia
year.
and
Year over
Kansas
year.
City.
Year over year.
Yeah, it's
Okay.
year over year in the fourth quarter.
San Francisco is the minus 1.4.
No,
LA,
but you're close.
LA, San Jose.
Orange County,
Oh, you're
where
home,
I live.
hometown.
Where I
Yeah.
live.
Yeah, where you live. Yeah. Oh, they're down minus 1.4. That home improvement
1.6,
project you did
1.6.
is looking less like a good financial
Yeah,
investment.
right. Yeah,
Yeah.
down 1.6, and then the plus 9.5% is
Philly.
no,
Oh,
but
that'd
good
be
guess.
good. Let me think. Is it a small area?
Oh,
of course. It's like Kalamazoo, Michigan.
it's
York, PA. No. Ocala, Florida.
It's
I didn't
Vero
think I was
Beach,
saying
Florida.
that.
Whoa.
Honestly,
Ouch.
whoa. I'm very so
this
what
is
you're
where Mark
saying
lives,
is-
Chris, half the
Yeah,
year.
I know. It's
Yeah.
it's unusual. Housing economists usually don't buy in places where prices go up.
I've owned this place for 15 years, Chris. I'm just saying. Yeah. Oh my gosh, really? It's up 9.4. I'll take it. I
9.5
I was
over
going to
the
say I
year.
don't believe that
Yes.
realtor data. Yeah.
So this is the National Association of Realtors median house price quarterly data, not seasonally adjusted in the fourth quarter of 22. 90% of the metro areas in the country had positive year over year growth in house prices, but there were a bunch that actually are now declining year over year, and most of them are in California. Most of the ones that now have year over year declines are in California, LA, San Francisco, San Jose, where I live, Orange County, all negative over the year, plus a few other metros like Nashville, Austin, Salt Lake City, right, that had a lot of demand over the past couple of years. Almost all of the metros that have the largest year over year increases still are in Florida.
Oh.
And so this is the realtors, right? So it's what's transacting.
This is right. This is the realtors.
It's
Yeah.
the median price.
And it's median,
Yeah. So that's influenced by the mix of homes
Right.
transacting.
not our favorite house price measure, but
Yeah.
but
But
very
you know-
granular at the metro level.
And it's what people are buying, so it's not unimportant.
That feels just weird. But I can't figure out why, what, I mean, you would see the high end's gotten hit harder So you would have
Right.
thought that that would bias lower the NAR median price, right? But it's not.
Yeah, and nationally, it's up 4% year over year
Yeah.
from the
Right.
NAR.
Yeah, interesting.
I guess
Oh,
it's
so
what's
that-
actually
okay.
transacting, right?
What's
Yeah,
that,
these
Chris?
I
these
guess
are
it's what's
sale
actually
prices,
transacting, right?
Sale
That-
prices, yeah.
Yeah, right.
If the lower end of the market is just there's no inventory, then I don't know.
So you think there might be just more transactions at the low end that's driving down the price? That doesn't feel right. Yeah, maybe. Maybe you're right. Maybe.
I don't know. It sounds like a mix issue, is what I'm saying.
Sounds like a mix issue. Yeah. Anyway, we're deep in the weeds. Yeah.
I gotta say, I feel very much at home here with you housing data nerds. This is fun.
We're right there with you, Chris. How many households are there in the United States, and how many has it changed over the past quarter or the past year? That answering that question is a debate we're having with each other, and we've agreed to disagree on that. I mean, which means there's no definitive number, which is really bizarre. I just find that so weird. But anyway, I'm ranting.
There's two ways to do it, right? And one way to do it is you say, we know how much housing there is.
Yeah.
We know the size of the
Yeah.
stock. We go out and we count what's the vacancy rate and the households or the residual. And so trying to capture how many housing units there are, I think is challenging because there's a lot more fluidity to the stock than we realize in terms of subdivisions and the like. The other way, so that's what the HBS does. The CPS says, I'm going to ask you if you had a household, and you, Mark Zandy, or however old you are, white male, and I know there's X million in the country, and of the ones who answered the survey, X percent say had a household, weighted up using the population control totals. What's interesting is the CPS and the HBS are the same survey, right? And but they each give a household count. One uses housing unit controls, one uses population controls, so we get two answers.
And quarter to quarter, sometimes like massive differences between them. Yeah, massive.
Right. And it's the same survey.
Yeah, bizarre. Okay, Chris DeRides, you're up. What's your stat?
61.6.
The homeownership rate.
Nope.
No, that's more like 66%. Yeah.
Yeah.
Is it a housing statistic, Chris?
It is. It is. One of the
Is
few
it-
housing statistics that came out this week.
Oh, and it came out this week.
This week.
Say it again.
61.6.
And it's not the realtors data.
Nope.
It's not anything related to, it's a housing, not mortgage related.
It is housing related.
It's not, it's housing related.
Oh, is it the
It's one of my
increase?
favorites. Go ahead.
It's one of your favorites.
I've used it before.
Oh, you have? Oh. Is it from the housing vacancy survey?
Nope.
Okay.
Is it the increase in the average monthly mortgage payment over the year?
He said it was housing.
Nope. That's not it, but
Is it?
that's
Oh,
a good one.
okay. It's along those lines.
No,
Okay.
I'm just saying, just acknowledging that would have been a good statistic.
Hey, can I just stop for a second and say, doesn't Chris look like George Clooney? A little bit? Look at him
Wow.
right now. Yeah, he looks like George because of the beard. There's like he's growing a little bit of a beard here.
Oh, I thought you meant this Chris. I mean, that Chris. I was being
Let's both
flattered.
take it.
Sorry, I'm so sorry. I'm sorry. That's so funny.
Yes, he does. Absolutely.
Doesn't he? Yeah. I'm
Both
just
look like
saying.
George Clooney.
Yeah, George.
You know,
Clooney.
my mother-in-law says the same thing.
Yeah, there's a Clooney-esque element there.
Not a bad person to look like.
Yeah,
No.
I'd say. Yeah. All right, back to 61.6. Give us a hint, Chris. Or you can't give us a hint.
Is it related to existing home sales?
No, it's sentimental.
Oh, it goes to sentiment. It's
builder
Fannie Mae
confidence?
kind of.
Oh, home builder
You-
sentiment.
You know, it's the Fannie Mae home price
Mae.
sentiment index.
Yeah.
1.6.
It's his favorite, and I never look at it. That's why I never get
Can
it.
you explain that?
Yeah, can you explain it? Yeah, good.
It's a survey they conduct to get perceptions of buyers and sellers' opinions about the market, right? So this 61.6, it's an index level. It's a combination of several of the questions that they ask. I guess the most important part of it is that it is up 0.6 points from December, which was the low, right? So it's consistent with this idea. Maybe we are coming off bottom, but we're not roaring ahead, right? Maybe we're putting in a bottom here. One of the key questions I would focus on is buyer sentiment, right? Only about 17% of the survey respondents said that it's a good time to buy. I'm sorry, 17% said it was a bad time to buy. 82% said it was a good time to buy.
Good time. Oh,
82% said it's a good time to buy.
I'm sorry, I'm
Yeah.
confusing that. 82% said it was a bad time to buy.
Yeah.
17% it's a good time.
Okay.
Yeah, that makes sense. Yeah. Oh,
Very
interesting.
pessimistic still.
That's a quarterly survey that comes out from Fannie.
Monthly.
Is it monthly? I got to start looking at that. Yeah, I don't look at that. I should look at it. Oh, that's a good one. That's a really good one. Chris H, do you want to go?
sure. I'll give it a shot. I'm not sure that I'm up for the caliber of this group, but here's the answer to the question is 42.
42.
Meaning of life.
42. And I'm sure it's housing related.
Housing related.
Yeah. And is it a statistic or is it just
It's a statistic.
It is. Okay.
If you tell
Came
us
out
the
this week.
units, will it give it away?
Yes.
Okay.
But let me see if I can give a hint. It's indirectly related to the supply issues we've been talking about.
Indirectly related. 42. Is it
Is it
a
a
release
measure of
from the
time?
government? Oh, sorry. Go ahead. Chris, Marissa, go ahead. You ask your
Is
question.
it a measure of time, Chris? Is it,
It's related to time.
like,
Is that the length of time it takes to put up a multifamily unit from start from permit to
or to get a
completion?
permit?
Number of months?
It's not, but that's actually not a bad number to have.
That 42 would be a long time though. That would be 3.5 years. That feels long, but maybe from start to completion. But that's not what this is. No.
That's
I'll give
the
you
time to
another
get
hint.
solar.
It was 42 at
Oh,
last measure in 2021, but in 1995 it was 28.
Oh, in 1995 it was 28. Is that I don't know. Is that I want to say the average? Is it days?
No, it's years.
Oh, it's the
The
it
can't
the age
be
of the
the
stock.
is it the
Can't be.
average? No, the home buyer is older.
It's not
than-
the age.
Is it the average age of the single family housing stock? No.
Of the overall housing stock.
Of the overall housing
Okay.
stock.
So it's the median. So the median
Oh.
housing unit is now 42 years old. It's the oldest it's
Oh.
ever been. And it was in 1995, it was 28 years old. So one result of not building housing is that the housing we have is a lot older.
Wow. That is interesting.
Interesting.
So in 1995, the average age of a
Median.
housing unit, single and multi together, was
Yeah.
28 years, and now it is 42 years.
Yeah.
Wow. That is an interesting statistic.
So you think about in the 90s, right? We had post-war, I mean, housing stock was old and decrepit,
Yeah.
right? And then we had enormous wave of building in the 70s and 80s, 60s, 70s, and 80s.
Oh,
and
that's
so
true.
we had young housing stock in the 90s, and now we haven't been building that much, and so it's old. So this is why the remodeling market's so strong.
Yeah. Of course, in the 80s, we had a boom in multifamily, right? Tax related. I mean, it was a massive number of units went up in the 80s. So that might have had an impact.
Yeah.
But it's interesting. Okay. That's a really good statistic. Okay.
Yeah.
You ready for mine?
Yep.
And it is housing related. I'm going to give you two numbers. Ready? 5.8 and 0.8. 5.8 and 0.8. Both, and they're, very much related. Same release. Housing.
Came out this week.
I think it came out this week. It's all blurred to me. So it's in the vicinity of this week. If it wasn't this week, it's in the vicinity. Spitting distance of this week. If it wasn't exactly, this week. This week went fast.
Housing, not mortgage.
Very, very much housing. Goes to supply, the supply issue.
Existing home sales related?
No.
Vacancy rate?
Vacancy rate.
Exactly. Very good, Marissa.
Homeowner and
Excellent.
rental.
Excellent. So what's the 5.8?
Rental.
Rental vacancy. What's the 0.8?
Homeowner.
The homeowner vacancy rate. So this goes to supply. I mean, the homeowner vacancy rate, we'll start there. That's the vacancy rate for homes for sale. 0.8 is the lowest on record. And that comes from the housing vacancy survey, the HVS that you mentioned earlier, Chris. And, obviously it goes to the 1.5 million shortfall in units. I mean, we are very low. And typically you would see a vacancy rate of 1.5%. So it's, we're about half of what we typically would want in a kind of well-functioning housing market. And by the way, that's one reason to suspect that if we get price declines, and we are getting house price declines, they should be modest, right? Because we have this really tight physical market, and that should provide a proverbial floor under price, and that should be very, very helpful. And it's across the country. It's all over the country we're seeing these kinds of shortages. 5.8 is the rental vacancy rate. Now, that's not the lowest on record. That was lower back in the 70s and 80s when we were putting up with all those homes, rental homes, and but it's pretty darn low. In a typical market, a well-functioning rental market, you would want a vacancy rate around 7. So we're still well below those kind of vacancy. So it goes to the shortage. So yeah, very good, Marissa. You got that one. Very good. Okay, let's we're coming to the end of time. I do want to double back and end it with one longer term issue. We kind of began with what's top of mind right now, the housing recession. I want to end with thinking a little longer run here in the homeownership rate. And I want to try something out on you, Chris Herbert. And I've tried this out on Chris D before, but I would like to try it on you. I'm nervous that the homeownership rate is at a high watermark, going forward. That going forward, it's going to be very difficult to raise the homeownership rate for 3 broad reasons. One's affordability. I mean, right now the fixed mortgage rate is about 6 to 6.25. In my calculation, in the long run, the fixed mortgage rate should be somewhere between 5.5 to 6. And so that means if we have an affordability problem at 6.25, it's still going to be an affordability problem at 5.5 to 6. So that is going to remain an issue. Second, the investors that we were talking about, my view, those institutional investors, they figured this out. This is a business model, and they're gonna take advantage of that tax code, all day long. And it's going to be very difficult, particularly for lower income households who need a mortgage, particularly get FHA mortgage, because it's going to be harder to get that home. And the third is just pure demographic. It's the distribution, the ethnic distribution, the racial distribution of the population. The white homeownership rate, the overall homeownership rate is 2/3. The white homeownership rate is 75%. The Hispanic homeownership rate is about 45%-ish, maybe a little higher. And it's about 40 for Black Americans. And we know that the racial composition of the population is going to continue to move away from white to non-white. And that mere fact means if homeownership rates don't change across races, that we're going to see the homeownership rate decline. So it feels like to me, unless there's some kind of policy change or we do something, 10 years from now, 20 years from now, 30 years from now, the homeownership rate is going to be lower than it is today. 2 questions. One, should I be worried about this? Do I care that the homeownership rate's declining? And that's become an issue. That's become more of a topic recently. And secondly, if we should care, do you agree with my characterization of things? And finally, I guess third question, what should we do about it to address it? So a lot there to unpack, and I'll just throw it into your court and have you respond.
All right. Number 1, should we care? I would say yes.
Yes.
And the Joint Center, we'd like to be fair-minded and equal. And so I don't want to say that renting is bad. I just want to make sure people recognize, I realize renting has value. There's lots of people who choose to rent. We have to have a well-functioning rental market, but there are a lot of benefits.
He is running for governor. Do you see how he
I just don't want to get a call from.
Yeah.
He's appeasing everyone.
Yeah.
No, but look, it's what most people prefer. It is an important source of financial stability. I mean, you can generate wealth. It locks in your mortgage payment. And there's a whole host of reasons why people prefer it. So I think we do care about it. I think it should be a policy concern. Particularly in a market where house prices keep going up, which they've only done over a long period of time. And so if you think about what just happened with house prices, if you were a homeowner you hit the lottery, right? Your house price went up 20%. And so you're a hedge, right? So you're insulated. So if it's in the housing market, I benefit from that upturn. So I think there really are a lot of strong reasons why we should encourage and enable people to not encourage, enable people to get into home ownership. So your second question was,
do you agree with my forecast that if nothing changes here, it feels like homeownership is going to be lower 10, 20 years from now?
Yeah, it's hard to see. Yes, I think all those three things that you pointed to. So the affordability, the demographic changes,
and just the racial composition of the population.
Yeah, are all going to be ones that'll make it more difficult to buy a home. And one of the things that we point to is, as much as the interest rates going up to 5.5% to 6%, but it's also house prices at the level they are. It used to be 25 years ago, typically prices were 3 times income. Now they're more nationally level, about 5 times income, and some markets they're 8, 9, 10 times income. And more places have that 5 times income ratio, like Denver, places that didn't have that. What that means is you have to have a whole lot more cash, even for a small down payment mortgage. And a lot of folks, particularly folks of color, don't have anywhere near that amount of cash, and they don't have the bank of mom and dad to go to. So I think the affordability issues are going to be really significant. And what do we do about it? Well, and here's the challenge, right? Is that you want to try to create pathways to homeownership that help the people who, but for it, wouldn't get there and aren't themselves inflationary. So I do think we need to think about having, and I'm a proponent of down payment assistance because I think that wealth barrier, savings barrier is a big one. I would be a proponent of thinking much more about how do we get targeted down payment assistance, and I think that folks have talked about first generation buyers that are like ways of targeting it to people who, but for this, might not get there. I'm also a proponent, we haven't talked about this much in policy circles lately, is of ways that encourage and match savings. I do think that you want to make sure people are prepared for home ownership, and the ability to save is an important financial skill and a signal of resilience. I don't think having equity in the house has proved to be as significant in terms of skin in the game. I think what we learned from the crisis was so many millions of people were underwater and never walked away from their mortgage. But the reason why down payments matter is because it shows financial capacity. So I think match savings approach is another way to kind of say, we're going to kind of limit who gets it because you're going to have to wait a little while to build up. But I think down payment assistance is really going to be important, and I think finding ways to make sure it's targeted to the right folks who need it is important.
Yeah, there's actually this cool program I think that's going to be unveiled in California, where the state will provide down payment assistance, and in exchange get a shared appreciation claim. They can, when the home is sold, they get a claim on some percent of the appreciation in the value of the home, so that they can take that money, the funds they raise to help make this thing a financing kind of down payment assistance program. That sounds like a pretty cool idea, particularly in a place like California, where generally house prices continue to move higher.
Right. And I think if you're going to give, it's one thing if you're giving folks $5,000 or $10,000 in down payment assistance, then it's not really worth the bureaucratic hassle of tracking it and getting a shared piece of it. But if you're in California, you're probably going to have to give people substantial amounts of equity to make homeownership feasible, and then having some ability to get it back makes sense. It's another way to limit it, right? Because if I have the ability to buy a home fee simple without that kind of entanglement, then I will. But if I need the help, then I'll take the entanglement. So it's a good targeting mechanism too.
Of course, these down payment assistance programs don't really work all that well unless you have supply, unless you've got homes that you can put people in. Like right now, we got this severe shortage. So if you layer on something that juices up demand and there's just no homes, it just jacks up prices and rents, and no one's better off as a result. So I think the first thing we got to do is we got to get more supply. We got to figure out how to produce more housing units and make sure that when there is, when we provide that down payment assistance, it just doesn't simply end up in a higher house price. So we've got to make sure we calibrate those things.
Yeah.
Christy, is anything there, or Marissa, that you wanted to add on the homeownership side that I missed? I mean, did you actually, Christy, because I know you think about this carefully, would you agree with my characterization of homeownership going forward?
As usual, I'm going to push back a little bit.
Okay, yeah, fair enough. Yeah, good. Yeah, yeah.
I think-
Well, can I just say as preface, and we're gonna end this shortly, but
Yeah.
we forecast a lot of things. We model a lot of things to help produce forecasts, and homeownership is, if not the hardest thing to model and forecast, it's pretty darn close. It's very difficult to get a good model for that. But anyway, with that as a preface,
Yeah, fair enough. I think a lot depends on your time horizon, right? Because the demographic trends are certainly changing within the country, right? So if you're talking about the next 10 years, absolutely. I think it's, you're talking, I think everything you mentioned in terms of the trends that we're seeing, that's all going to take place. And yeah, very hard to push up the homeownership rate. As we get on to 15, 20 years from now, given projected growth rates in the population, the aging of the population. So you mentioned the age, the racial composition of homeownership, but there's also a very strong relationship with age, right? So as the population ages, even within those racial categories, you're going to get more homeownership. So I think that might be a factor here, but just abstracting from that, as the population, as household formations actually start to come down, right? There are going to be more opportunities. We could go from too little supply to too much, having excess supply.
Oh, I see.
In terms of housing, potentially. It all depends on what goes on with the birth rates, immigration policy. But as you get further out, I suspect we're going to look a lot more like Europe than we have in the past, where we do have. Well, that's another question. But in many countries, where you have this older population, you do have fairly high home ownership rates. So that would be my own caveat here. It depends what time horizon we're talking about here.
Right. Got it.
And I think that's a great point, Chris, because we get caught up in the conditions at the moment and feel like this is a permanent condition. And I think, we talked a little bit about household formation, which is running really high. But if you look at the demographics, our projections, and they need to be updated when we get some good population projections from the census, says we're going to slow to about 1 million households pretty soon. And that's a whole lot less than we have now. There's a piece, I don't know if you're familiar with, I think Gary Engelhardt did it for REHA, looking at baby boom turnover. And he estimates that it'll be about 4 million housing units a year coming from the boomers, as they get into their 70s and late 70s and 80s. And so there is going to be a big existing supply response coming. So we could be in a very different market. And I'm not sure of the timeline, 5 years, 10 years, certainly 15 years. So I think your point's well taken.
Yeah, good. Well, we covered a lot of ground, and I'll just end by throwing out a open-ended question. Chris, did we miss anything we should have been talking about? Is there any issues that you think we missed? Anything glaring? No?
Nothing glaring, I would say. The one thing that that's percolating up a lot more on the policy front is the question about enhancing tenant protections.
Yeah.
And 5 years ago, people said to me, "What do you think about the possibility of rent control?" And I said, "That's never going to happen." And now, obviously, various forms of it. And I think it's important to distinguish between what Oregon and California have done and what St. Paul did. But and now the Renter Bill of Rights that the Biden administration put forward, very contentious. But I think given the fact that I would say that tenants don't have a lot of protections, and given the fact that staying stably housed is so important, we need to have a real conversation about what would sensible tenant protections look like. Sensible meaning they don't discourage supply, that they don't demean the role that landlords play in providing this housing, but at the same time, rent increases of 20% are really hard for people to tolerate. And so I don't know. This is a debate that seems to be growing, and one that's filled with a lot more heat than light. So,
yeah, and I kind of feel the kind of the political ground shifting here a little bit. So you're right. I mean, economists hate rent control. For the obvious reason that if you control rent, you're going to restrict supply. I mean, builders aren't going to put up units, and that's the exact opposite of what you want. But you're right. I think there's kind of more nuanced thinking around this that's going on. Maybe there's some things that can be done to help address this issue. Hopefully, we get more supply and vacancy normalizes, gets back up to that 7%, and rent growth normalizes, and then we'll be okay.
Right. But maybe it's subject for another podcast for you with some appropriate.
Yeah,
guests in the
exactly.
future.
Yeah.
This is a enormous. I live in California, and you could do a podcast on housing in California. Just there's so much going on. There's still state moratoriums on rental increases in effect, layered on top of county, like Los Angeles County has their own. The city of Los Angeles has their own. I have a friend who's an attorney in landlord tenant law, and she just said it's week by week changing regulations that she has to keep up with to understand what the state's doing, what the county's saying, what the city is saying. And yeah, it's a huge debate here. Just if you take Los Angeles, and then there's the homelessness issue on top of
Sure.
it too, and
Yeah.
trying to find housing and converting commercial buildings to residential units. So there's a lot going on that I think is fascinating, that I would love to hear your expertise on at some point, Chris.
Well, we're gonna have you back, Chris. You can see we're already setting you up for the next podcast.
Yeah.
So it was your fault because you brought it up. We didn't. But thank you so much for joining us. It was a wonderful conversation, very thoughtful and insightful, and we will be in touch because we do at Inside Economics give our guests a small token of appreciation, that's within the guidelines of Moody's gift policy. So but I will be in touch in that regard. But thank you for spending the hour plus with us. Much appreciated. And with that, dear listener, we are going to call this a podcast. Talk to you next week.